let me start with Mukul. And since the question is about business models and IPOs, at least the topic said that. Let's start with the business model part first. So Mukul, you started with B2B SaaS. It's one of the unique B2B only SaaS, at least SaaS for sure, B2B companies in Edtech, one of the few ones. And but over the last so many years, you've kind of pivoted to B2C, etc. So just to understand the business model and the part about B2B was what got Bloom very excited. There was a very differentiated business model. What led to the journey from B2B to B2C, and how has the business model kind of evolved? If you can share in the next 2, 3, 4, 5 minutes.
Yeah. So small brief to that. Like our original product was, and it is still is, by the way. Like unlike a lot of pivots, that product is still there. It keeps still growing on, has turned profitable, does well. So as a shareholder, you will not be disappointed with that bet, Sajid. So, but yeah, so our initial product was basically a SaaS for creators to come and sell online courses and monetize their social media following. So if you have like a few thousand subscribers on your YouTube or Insta or Telegram or WhatsApp, wherever, like if you want to monetize them instead of doing brand deals, which educators cannot do because it looks a little off, the right way is to basically sell them online courses, right? And it's good on the demands, for the demand side, they get it cheaper and distant, and for the supply side, they make money. Uh, Gradually in the journey, we realized that while that business was continuously growing good, and SaaS is traditionally a very high gross margin, and uh, after a certain cost of capex, like you essentially break even. So we started seeing that effect. But we also realized that there are B2C brands that we can help in, like the kind of network and assets that the entire SaaS had built. We realized that we don't know how to run a B2C brand, but there are B2C brands in the country where we can directly assist and not just assist them. We also realized that there are a lot of value props in those B2C brands which can be used to assist our own customers, like the creators and educators who are using our SaaS to grow their business. We realize they can also benefit from the assets of B2C business. And I think that is where in 2022 we made a big strategic investment in a company called Textbook, which was, I think it still is one of the largest destinations for government job aspirants in India. Like government jobs is a very, it's a tier 2, tier 3 phenomenon that is why it does not get spoken, but like 30 million people, which is like 3 crore, people actually give government examinations every year, right? Just to give you an idea, JEE is given by 10 lakh. So the TAM is like much larger at a much lower AOV, obviously. In 2023, then we did another strategic investment in a company called Gyan Life, which is again a Gujarati platform. And then in 2024, we launched something called Polaris School of Technology, which is like an alt university for anybody to do their 4-year undergrad, right? And we realized that in all of these cases, like we could add value to the businesses, and these businesses could also add value to our creators and educators using SaaS. And so this was a very synergistic play, while it was hard to envisage, but we built it brick by brick. And from like doing 5 million of rev in FY22, we will probably finish FY25 at 45 mil. So that's like a 9x in 8 years.
Wow.
Turned profitable last year. Did that not just for a month or two, but for quarters and multiple quarters. And we still like have all the money that we raised in our last round still in the bank for more investments and acquisitions, right? So we just realized that like any edtech company has a lot of assets which are unutilized if you just go in a linear way. So we thought that why can't we build, rather than going and shopping like assets just to basically buy revenue, we said how can we basically build an ecosystem where the SaaS is being helped by consumer brands and vice versa. And I think that is the play that we are trying to make.
Got it.
Here.
So SaaS at the core, leveraging SaaS and creators to buy strategic assets is how you've kind of built
In
the
fact,
business model.
the funny part and the fun part, not funny part, the fun part of it is that the earnings per creator has actually, across the entire base, has actually gone up by 18 to 22% over the last 3 years because the creators can also leverage the assets that are now in the Class Plus overall group.
Got it.
So everybody wins basically.
Got it. Cross synergies. I'm going to use that to move to Nikhil. And Nikhil, so one thing that's distinct about Class Plus is it's heavily online, and it's leveraged the creator synergy well, etc. What's it been for Emarticus? I think it's largely been the an offline journey for you. Do you want to just talk about that and what differentiates your business model?
Sure. Look, we've been doing Emarticus for about 10, 11 years now. And our first foray into the business was through an offline center in Bombay. Post that, we now have about 20, 25 centers. And we've believed in this offline story for a while. And for the simple reason that we were solving in our business, in our initial business model, the employability problem. And there, the idea was to make someone employable. We figured out that to make someone truly employable, you need about 16 to 17 different touch points. Now, to do that in an online format was very restrictive, if you will, and very difficult to do, etc. So we believed in the idea that having these offline centers for training, for placement mocks and placement readiness is super imperative to the business. And we sort of stayed the course. We got some investor hate for it in terms of saying everything is going to go online. COVID came and smacked us around particularly. But I think staying the course in terms of has made sure that our outcomes have been met when it comes to employability. And frankly, the most profitable part of our business is these centers. So I think, very keen, have always been keen on offline, will continue to remain offline, at least in some of the segments. We have now taken up some online by segments, if you will, where it makes sense. But again, we are always outcome first. So.
Are you comfortable sharing revenues like Mukul shared?
Yeah, close to 250 crores in revenue, about 25 to 30 crores of EBITDA this year.
Got it. Oh, okay. So about $30 million and what, 3 million EBITDA. Okay, fair. Okay. Pranjal, I was told before coming here as a sponsor, I'm supposed to ask you very soft questions. So I've got a lot of very soft ones lined up. Yeah. So, sponsor power, yeah. So, Pranjal, look, both of us were on the other side once, right? You were a VC, and I remember having those conversations and complaining about Mukul and, no, it's just confidential. Stays in this room, okay? Are we being recorded? Oh, yeah. So, now you move to the other side, right? An exciting company, etc. What led to Ashwin convincing you to kind of take that jump? What led you? What was so attractive about the business model that you kind of moved over from the VC side to the operator and builder side? Do you want to talk about that?
So I think, is it audible? Hello? Yeah, this is better. Okay, thanks. So I think, let me address the question on business models. And of course, in that wave, my journey. As an investor, when I looked at multiple opportunities, especially in the education space, I would not say Edtech, I would say education, and we'll come to that in a minute. I think as an investor, you always look for three things. Number one, is it a defensible model, which means you have a right to win, or it's a much cliched word, moat, but I think it's an important one. Number two, is it scalable? Some of us confuse scalability with being online, but scalable. I'm not saying accelerated scaling. It's not about time horizon, but scaling. Right? So that's second. And then third, clearly, is leadership. And I want to bring leadership also into the business model piece, because I think fundamentally a same business model done by a A+ leader and leadership can be very different from the same business model done by a not so great leadership. So all these three were spot on in the company. When we invested in 2016, the company was profitable. As we invested, it became unprofitable. Yeah. And we'll talk about that. Why you should not take VC money. We can have that spice in this conversation. And you should thank the VC ecosystem for keeping you in the right direction, I would say. But yeah, so I think that those were the primary reasons for
defensibility, scalability, and high quality of leadership.
I think those are important ones. The model was global, which was immediately exciting. We work with top-tier partners, which are extremely, extremely selective. And there was very clear understanding that, yes, this is a company which will do it. And there's a different DNA for it, because you have to be academic in your thinking and outcomes while commercial in execution, right? So that sort of DNA of thinking academic and outcomes while being commercial. Last thing I'll say is, what I felt, education is not e-commerce. There's no LTV to CAC here. You have to make money in your first sale. I know making money in an education conference is a bad word.
Yeah.
But still, as a commercial person and a business model person, I would say you have to make money in the first sale.
Got it. So some interesting points there. Academic outcomes, commercial orientation, make money on the first sale. And there was one more you said, which kind of lost. It's too many gems. Huh? Global, yeah. So too many gems in one go. Yeah, so that actually, you kind of touched upon one interesting thing and this is sort of something what we were discussing, and that education is a great business. I mean, though we shouldn't say that, but education is a great business. Very few unprofitable education businesses, right? It's hard to make losses in education. But Edtech is not. Very few large profitable Edtechs, right? Count a few, right?
Quite a few are here.
Yeah,
Yes.
yeah. So, yeah, few, right? So, what's the reason? Maybe we'll start with you, and then we could kind of go to the others. Like, why is this duality between edtech and education?
No, so I think it's a, and I can go on for a while on this theme philosophically as well. But I think the important thing here is that unlike consumption, which gives instant gratification, education is not giving you instant gratification. What I mean by that is, if you go to for any service, let's say to a restaurant or anything, you can immediately attribute the outcome of either you being happy or not happy based on the service that is provided. Similarly, you buy any product, you can immediately experience that product and you know whether you're happy or not happy and the value proposition is worked or not. Education is one such offering where it takes a cycle time for you to realize, and the attribution may be weak. Even if you take test prep, for example, it takes 3-4 years for that child to study in a test prep environment and then crack the exam, and there are multiple factors towards it, right? So I think patience, one important thing, which is I said scalability, but not necessarily on a time axis. Giving an example, we founded the company, when the founders founded the company in 2011. It's been 15 years since we are now here, and now we are at that scale. So it takes time. I think a lot of edtech founders think that edtech is more tech than education. That's the second issue. It is actually education and not tech. Tech is an enabler. So you have to think about learning outcomes. You have to think about attribution. You have to give it patience to do it. Once you've done all these three things, you also have to, and we'll talk a little bit about how much money you should raise and not. That's another thing you have to sort of be careful about. Because a lot of education companies or education players have not raised investor money.
Yeah.
Right? And scarcity sometimes gets you to the right answer and the right model. So I think that, is what makes this. In fact, just as a side note, I was discussing something with one of the early stage investors, and they said that, look, we make it a point to not give somewhat lesser money than what the model needs, because you have to keep that discipline.
Constraint breeds creativity, as we've seen with DeepSeek. Yeah. So I'll just more to Mukul. And Mukul, this business model is something that you've spoken about previously as well, on how business models have evolved and how you've seen the business models evolve. What has your thinking been on how business models have evolved? And specifically, in general, not so much ClassPass, which you refer to, and specifically in the context of ed versus edu, do you have any specific thoughts on that?
There are actually two tangents to it. So one is basically ed things being profitable. So most of the ed things that we call being profitable, they've been in existence for a couple of decades now. So the moment you start comparing some platform which is like half a decade into operations versus those, they have had compounding of results, which is what Pranjal just quoted, right? So I think one in general, sorry for saying this, but like most of edtech is actually judged by probably half a dozen companies who did not work out for whatever reason they did not work out, right? If you look beyond that, like most of the edtech companies that I would know, if not profitable, they are at least contribution margin positive. That means that now it is a matter of scale. So that is one, like you're comparing 5-year journeys to profit, because most capital in edtech has come during and post-COVID, if you look at the lion's share of it. So one that. Secondly, basically now coming back to more about the things that why edtech companies do not do it, I think the burden of this lies on both, but I think everybody, whether it's the founder or whether it's the capital partner, everybody loves overestimating the TAM of EdTech in India. And I'll tell you why. The most common thing that they do while, and everybody has done like pitch decks and IC notes, they assume that a brand which has a loyalty in one particular segment can scale horizontally, which does not happen. Like traditionally, even in ed, that has not happened. The biggest school chain in the country has not been able to do test prep. The biggest test prep chain in the country has not been able to do upskilling. And the biggest upskilling chain in the country would have not been able to do something. Because EdTech, education in itself is a very vertical loyalty kind of a market. But yes, for doing, and I fully agree with, like LTV is equal to AOV in EdTech. But to basically raise capital or to justify their pricing models, everybody just loves expanding and showing EdTech as a, let's say, an LTV game, like an e-commerce or an RMG or a food delivery or whatever else. But it does not happen that way. So you'll in your lifetime, if you're lucky, you will probably build one brand which will have one hero category, and there's a particular format and a price point that you will stand for. And anytime you basically overtly estimate yourself in your ability to go horizontal, you will essentially start sinking money, because you can't buy loyalty in high criticality choices with money.
Interesting.
And that goes for critical healthcare, education, everything else. Second thing, which like I really hope like most founders in the country realize, it will be a win for everybody. So in economics, we used to study something called price elasticity. There is something called price inelasticity, where your perception and adoption of a product increases with the increase in price. Education is one of those very few segments. In fact, a lot of people do not realize that if you price your SKUs too low, the consumer thinks it's a cheap one. Like if I tell you that your kid can learn, let's say, a UPSC coaching in 15 rupees per month, it does not increase your odds of him selecting it. You will most probably be alienated towards it. And everybody thinks that providing education at the cheapest rate is the motto of the world. Nobody said, the consumer never said cheapest rates. They're happy to pay more as long as the quality and odds are more. So, but the cheapest part is the most attractive, because that is in the founder's hand. Because the effort required to cheapen your SKU is far lesser than the effort required to better your SKU. And I think that is one more mistake that I've seen, like most people. We have also been guilty of that. Like 3-4 years back, we reduced our prices. For the last 3 years, I think that has been the core of the company. Like we'll probably move the pricing up, but we'll move the quality essentially 2x up. So I think that inelasticity, and I think all three of us in our own respective segments would be one of the priciest SKUs. Like his AOV is probably like I won't even comment on that. Right? Yeah. So maybe
It's too much.
Too much.
yeah, it's more than the GDP per capita of the country. I'm pretty sure, right? So much more than that, actually. Probably 10
Curious,
times of
actually,
that.
what is your AOV?
Okay. So yeah. Once you're done, we'll move to next.
So yeah, that is my thing, that these 2 or 3 caveats is what get most overlooked, and that's why. Yeah,
So we'll come back to you. Nikhil, I think it's a great opportunity for you to add to that. And I think some interesting points shared that about Mukul, about when it's a very high critical category, it's very difficult to buy loyalty with money. That I think kind of stayed with me. Pranjal's point about education is not a category we should look for LTV. It should be one and done, right? So that's it. What are your learnings been over the last so many years? Like what are the insights that you've gathered and that inform your present business model?
Look, I think, first of all, I completely agree with both their points. One being that investor and founder expectations on EdTech have to be sensible, right? Which says a lot, which does, that changes the way you look at this business, what you do about it, and so on and so forth. The other piece that I think we have been, frankly, as founders, a lot of us have been lazy. And I'll tell you what I mean by that. So when it comes to acquisition, for example, we have over-relied on digital acquisitions, etc., and which has made most of our businesses very, very unprofitable. The gross margins in our business, true cost margins in our business, are the worst I've ever seen in any other business. For the simple reason, we are spending money on the wrong, you should be spending money on learning, on placements, on outcomes, on experiences. We are spending money on Google and Facebook. And actually, one of the biggest things we did after COVID, actually, and we had COVID came and slapped us around, And we actually figured that out, that non-digital distribution, today Marticus, 40% of our revenue is non-digital distribution, and that is the most profitable part of the business. If we were only digitally, frankly, digital distribution, we'd be, again, loss-making. So to me, I think being, frankly, not lazy about acquisition, user acquisition, because it's easy to spend money on performance. I mean, it costs a few dollars, a small team, if you will, etc.
You have offline centers, and you mentioned about the 16 points of differentiation, etc. Now, to acquire them, do you not go digitally and Google and AdWords, or how do you acquire them?
We do have a digital but almost we have about 300 people plus team that are non-digital, which go to colleges, which go to corporate business parks, and so forth. And that acquisition cost is 10 to 15% versus the other one would be 25 to 30%.
Got it.
Right? So that makes the biggest, particularly difference. My personal belief in the sector, and I was saying that we should retitle this to say how do we make more money.
Yeah.
But more importantly is that how do you increase the gross margin of this particular business? Because overheads are overheads, if you will. There's only so much you can do. So I think whether it's an acquisition cost, whether it's in partner cost, which I'm sure Pranjal and I deal with on a daily basis, I think we have to figure out how to increase gross margins in the business.
True. So, yeah, you want to take?
I told you that we'll flip the question and we'll become the moderator and you'll have to answer. So this is that moment which we didn't prep for.
Yeah.
But I think in the business model, Sajid, there's one more stakeholder, which is the capital provider, right? And I'm a big vocalist of saying that one of the reasons business models get made or destroyed is having the right capital partner.
True.
And that is more valuable than valuation and other things, right? But in your ecosystem, are you seeing that maturity that based on the sector, the investors are asking the right questions? For example, even at this stage, we just closed a round, even at this stage, we get asked what is your LTV to CAC? And I have sometimes this trouble explaining them that, look, that is not the metric for us. So when you sit on the other side, are you seeing that maturity happening in the ecosystem?
I really want to know away from you. Because you don't need the money.
So that's an interesting question. So I would say that companies which are first of their kind, which are category creators, bear a unique burden. So category creators have to continuously explain TAM. Okay? Number 2 को explain नहीं करना पड़ता. Flipkart never had to explain TAM. Amazon had to explain TAM. Urban company always has to explain TAM. The number 2 guy never has to explain, right? So category creators bear a unique burden of explaining TAM. To help the VC understand TAM, and the truth is, TAM is a unique thing for VC. Okay? TAM is a carpet under which many no's are buried. Okay? Because ना तो नहीं बोल सकता, like he'll say, यार वो ना TAM का question रह गया यार, वो TAM थोड़ा कम था, like, and like, I mean, I haven't done it personally, but I promise myself that I would never do it. But it does happen to some of my portfolio. But I would say that, and LTV and CAC, some of these questions, which you feel like now they should stop asking. And this actually Abhiraj told me, Abhiraj Bala of UC told me, ki even in our $2.1 billion, the last round which they did, even there, that person asked. Because for that guy, he still has to give a 5x return or 6x return. Whole time, he will sit and ask. So the problem is, if you're number 1 and you've been a category creator, that will never stop. Aap IPO jab karoge, the bookmakers, them also will be explaining this. So, yeah.
We can move to that section then.
Yeah. So we'll move to that. 11 minutes. So, Nikhil, this is where you're going to vent, okay? And we're going to have therapy in public. They've raised a shit ton of money. We won't say how much. He's got all the money in the bank. For you, it's been a very different journey, despite being a banker, etc. So you struggled to raise capital, and you haven't had much love. Why didn't VCs understand you? What was the challenge? And do you want to call out? No, we don't call out any VCs, but
You're going to make sure I never get money.
No, but yeah. But what didn't work out, and what do you wish you could have told the VCs then? Yeah.
Look, I think one, in terms of us not raising capital, I mean, a lot of people come to me and say, it was right for you not to raise capital. I'll be honest, sometimes the timing didn't work. Sometimes we wanted the capital, they didn't want to give it to us. and sometimes vice versa. They wanted to give us and we didn't need it, etc. So when I wish I could say that it was extremely strategic and I was completely against capital raising. So it was not like that. I remember approaching you for capital, etc., which he didn't give me. Having said that, I think what not raising capital did is it definitely created a culture of not doing stupid things. We sort of, frankly, did not have the money to do stupid things, so we didn't do them. And in terms of understanding VCs, and not to name them out, I personally feel a lot of the VCs follow a trend. For example, I was told offline business is going to shut down. I'm not sure why you're doing offline centers. Ye sab band hone wala hai, everything is going to be online. Then online, COVID came, etc. Online is going to close, offline is going to remain, etc. So I personally believe that, and I tell fellow entrepreneurs this all the time, that they said, look, I'm doing this because a fellow VC told me or a VC told me. I said, look, the guy has spoken to 10 things and he's telling you the exact assimilation of all 10 things he's met. He's not run a business before, and with all credit, they know a lot of things, but they have not run a particular similar business. So take them with a big grain of salt, right? But having said that, I think in terms of, we have gotten a lot of strategic direction which we have taken as we have built the business, whether it's diversifying from finance, whether it's actually creating multi-channels from non-digital, etc. All that has been good contribution from the investor community.
You had some investors, not institutional investors.
Yeah, very little. In total, we raised about 20 crores.
Wow, it's great. So just from next steps, and you mentioned 250 crores, 30 crores, EBITDA, etc. What's the next thing looking like? Obviously, you don't really need the money unless you need it for acquisitions, etc. Is like an IPO on the cards? What's the path to,
So we've done a few acquisitions in the last 3-4 years. The running joke in my company was, you're a banker who hasn't done any acquisitions, if you will. So we've tried to fix that in the last 3-4 years. We're looking for larger acquisitions in terms of that, and for that we'll raise money. But the idea is to access the public markets over the next 12 months or so.
12 months.
So we're getting the company ready. We're doing all the things that need to be done from a compliance perspective. One of the big things that we are starting to do is also, how do you get predictable revenue, predictable profit on a monthly basis? I think that discipline, that cadence that you need is something, we're getting there, we're not there, but it's something which is going to be happening over the 12 months.
Oh, it's interesting. Yeah. So from there to you, Mukul, like what's the path for you? So you're pretty much in the same revenue ballpark, a little larger maybe. How are you thinking about the next steps in the company as you sit with all the money raised in the last round in the bank?
Yeah, so I think, two tangents to that. So one, we've realized from the limited conversation that I've had with, and I only trust the information given to me by the founders who have gone public, because everybody has a vested interest in us going public, right? So what people have told us.
You don't trust me?
You said it in so many ways.
I said I trust you with a vested interest. Yeah. Sajid, you tell me you don't have a vested interest, I'll trust you everything. Right?
No, go on.
So, yeah.
Go on.
What I realized that beyond all the glam part of it, I realized that it is nothing but a funding round in public, from public markets. That is what I realized. I might be wrong, and I am actually very naive in understanding this today. But I realized that it is, so it's like that when our Series A happened, we thought that we have won the world. And then the next day, basically, we realized that nothing had changed. We had more responsibility, and we were accountable for delivering something more. And I'm telling you, as a founder, I did not realize it at that point that we actually thought that our first 10 million check is where now we have made it. And we said that now nothing will change. It will just add a zero to the check, and the dynamics will be the same. So I think so what we have internally said is that that IPO is probably on the right side of the equation. On the left side lies things like, what do we need the capital for? Do we have a predictable path for the next 3 or 5 years? What are the next few TAMs that we really want to do? Do we have the right team in the place who can shoulder those expectations? Is margin expansion in the company that will keep on happening? And we realize that unless we do not cover like all, not most, we realize that until we do not cover all of these things in prior, it will just become like a festival where like everybody celebrates, clicks pictures, but at the end of the day, you now have a much larger responsibility of ensuring capital protection for everybody who has been participant in that. And if we don't do all of these things in prior, we would be doing injustice to not just that, but to ourselves and everything else that has gone in building the company. So I think the last, like, going public, and again I'm very naive to say that, but going public because of FOMO, I think from first principles might be the worst thing to do in life. So we don't know when we'll go, when we not go, but we know that we will at least not go public in FOMO. Just because 5 other edtech companies or 10 other consumer companies are going does not mean. And people say that markets are hot, go today. I'm like, what if they are not tomorrow? So they're not going to be that way. So we want to do it in a very first principle manner from whatever we have learned over the last 7-8 years while building the company.
Got it. No, fair. You want to go do it for the right reasons, not because there's a trend or a wave, etc. So yeah. So Pranjal, I heard that you're going to want to make some announcement today. No? Yeah. Yeah. So how are you thinking about it? So you're clearly the largest company here, at least on between 3 of them. So how are you thinking about it, and what do you see as the next stepping? What are the steps that you put in place as you kind of get ready to kind of move to the next milestone?
No, I think Mukul put it very correctly. All the points that he said on the left side of the equation are extremely important. I think as a sector also, we have unfortunately have been saddled with issues both in the private market and historically in the public markets of doing premature or unreasonable or things, etc. Right? So there is that responsibility also that we have to shoulder. For us, I think increasingly it is becoming a question of, okay, when are we ready? So it's not a question of whether, it's most probably a question of when. When are we ready? When are all those building blocks going to be ready, etc. There's no announcement that I'm going to make here, except please don't hound me. It's not going to happen in the next 12 months. Yeah. All the ecosystem advisors that are sitting here, please note, it's not going to happen in the next 12 months or so. Nikhil is the guy for you.
Yeah,
there.
He's clearly announced it.
He's clearly announced it. But I think one thing which I will say, again reinforcing more what Mukul said, I think in our mind, it's another point or a milestone in a big, longer journey. Also keep in mind that, look, from our perspective, one of our biggest stakeholders are our university partners. So, we have to be very deliberate and measured about what we do, get a strategic alignment with them. So we will have to be a lot more deliberate in all these sort of actions. So yeah, I mean, it's when building all the blocks. I think it's just started at least financially doing certain measures, etc. And then I think we'll see when is the right time.
Got it. So yeah, so I think almost at the end of our conversation, and I think the broad takeaways, if I could kind of say, is one is it's okay if you have not raised too much money. Constraint breeds creativity. And that's forced you to kind of discover very unique business models, offline oriented, which actually had higher effectiveness. In Pranjal's case, like they've gone deliberately, started a long time back, 2011 you said, right? And they were profitable in 2016 when Bertelsmann led the check-in to them. That's when Pranjal was in Bertelsmann. And what's worked out for them is their very distinct academic outcome, but commercial orientation. I thought that was a very interesting kind of way to put it. In Mukul's case, there was a consistent focus on creator outcomes, in ensuring that creators, in which case creators are educators, right? Educators succeeded, and they never did anything which was against the educator interests. So what to me comes through all of the 3 is they've discovered unique business models which are defensible, which are scalable, effective, and they protected that. And they never let either capital raising or the lack of capital raising worry them too much. They never let VCs come too much in the way of running the business. So that's the fundamental takeaway here, that you need to run the business.
You have to say that without laughing.
Sorry?
You have to say that without laughing.
Yeah. Okay, that'll be tough. But yeah, so that I think is a takeaway for us. Thanks for really a candid session, and appreciate it. Even though we didn't get dates out of everyone, but thanks for this.
Thank you, Sajid, for this.